Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Interesting point. Nick wants to know, and of course this is the $64 million question, and I know you can't answer this, but I'm going to throw it out anyway, Jack. Do you think $1.60 euro versus the U.S. dollar, which is of course the inverse here at the ISE, would be that EUI number will be much lower? What do you think? Is that something that's preposterous, or is it possible? I guess anything is possible, but what do you think?
Yeah, well, we don't think we're going to see 160 again for a while in this cycle, but we saw a pretty quick surge back to 147 in the euro in an environment in which the dollar wasn't trashed as much as being trashed by our government at the moment.
Right.
So we say that with the idea of 160 in terms of. You've seen it, Steve. Things have happened in this cycle in which, a year ago we would have said there's no way that's going to happen. So to try and say 160 is preposterous, I would never say that in this market. But in general, because of the global macro, we don't think this optimistic period is going to be sustained enough to see the euro rally quite back that far. But we're open to it. It surely could.
It's interesting because obviously if it's going back to that level, you'd be looking at the puts here at the 66 strike puts would probably give you, a nice play there at 68 cents. Not that I'm recommending it, but if, you believe that it was going to get all the way back to its previous high, the euro, then these puts are going to escalate in value. Fred wants to know, Jack, do you see this current stock market move as a bear market rally or the start of a new bull market? I think you've already answered that, but again, you want to just maybe just give us 1 point on that.
Yeah, we see it as a bear market rally. We're not sure if we'll see new lows, but we suspect we'll see maybe a test of the new lows in stocks. Stocks always discount. Sometimes the global economy can get a lot worse, and stocks can do just fine because of their ability to discount many months ahead. But we do happen to think, just because of the fact that this whole idea of this green shoots and all this optimism, we think is a little bit of a false optimism. And again, only because what we continue to read and see in China, until we see a real turnaround in export demand in China and import demand, we see both those going. Import demand suggests there's something going on in their domestic economy that is good. Until we see that, we're not buying into this idea that stocks are going to continue to surge straight up. We do think at the moment it's a bounce in a bear market, but again. We're sure not stock market experts. We use it really just as a correlating factor and a risk appetite environment factor to help tell us that.
Thanks, Jack. One last question. I know that you trade futures and you trade spot and you trade options. Can you just outline the benefits of trading options over spot? We don't need to touch on futures, but just the two asset classes and how do you look at one versus the other?
Sure. That's really quite easy. And as I said earlier, trading the options, and again, we trade them very simply as directional bets. We buy a put or buy a call. We keep it very simple. The advantage is if you buy a put or buy a call, you know exactly what your risk is. Your maximum risk is that premium that you paid. You can't lose any more than that, plus whatever commission in the deal. And oftentimes, if you see that you're wrong in an option trade, you can salvage some of that premium. In the spot market, you're completely exposed, meaning you have to be disciplined and put your stop-loss orders in and those types of things. And in general, in the spot market, it's very liquid and the stops are hit right on the button. But that's not the case over the weekends. Things can gap over the weekends, and you can gap through stops. But again, it doesn't happen that much. But in general, you expose your account if you're not disciplined and watching the market in spot. And also the fact that often most people trade with too high leverage in spots. So a move they may be right on the longer-term trend or at least the weekly trend, but get stopped out or have to leave a trade in the spot market. Whereas if you're trading the options market and you have a real powerful view on an intermediate-term move based on some of the fundamentals, if you get a little adverse move in price, you're not going to run out of that options trade. You've bought yourself time to let your fundamentals play out, where you tend to run out of that move in spot, and it may turn around and go exactly like you said, and you would miss it in the spot market. We did exactly that with the euro. We were in a spot market move. The euro is 155. We thought the dollar was turning, and we shorted the euro. We also bought, in this case, it would have been long-term euro calls, dollar-euro calls on ISE, expecting the euro to break. The euro went to 160. We were stopped out of it in our spot trade because there was too much leverage, and sure enough, it turned around and went straight down. And in the options trade with our longer-term view, we made a bunch of money. So that's really the advantage. And as I said, you don't have to watch that market every day. If you're in there in the spot market, you basically become a screen junkie.
Right. Yeah, Jack, I think you were saying at the top you were actually bearish on the euro, so you'd have been buying puts here, right?
We were bearish on the euro.
You're bearish on the so you're bullish on the U.S. dollar, buying calls, correct?
Right.
All right. I just wanted to quantify that. Let's see if there's any other question. Remember, just to keep it simple, if you're bullish on the dollar, you're looking at calls, and if you're bearish, buying puts. So, depending on your view, there's always an ability to trade this, whether you're bullish, bearish, and even as Jack said earlier in the presentation, you can create other strategies. Not that Jack doesn't use those strategies, but there are other option strategies. If you like doing spreads and, iron condors and butterflies, it's available to you. Jack, I want to say thanks a lot. You did an awesome job, as you always do.
Thank you.
Just making it, thank you, so simple for all of us to understand because, again, currencies, because they're relative, seem to be more confusing, but you make it so simple that I've learned so much over the last couple months working with you, and I look forward to next week. We're talking about the U.S. dollar, the dollar's Achilles heel, and that'll be on May 28th. The following week, we're going to talk about why the euro could disappear on that's on June 4th. June 16th, you'll be talking about the dollar versus yen and the carry trade. Is it over? And then I'm really looking forward to June 24th on the risk and benefit to the global currency market, looking at China. So all these different topics are going to be so interesting, and there'll be more to come in the summer. So, Jack, thank you so much for all your interesting information today.
Thank you, Steve. I really do appreciate it. Thank you, everybody, for your attention this late in the day.
Thanks so much, Jack. And I just want to remind everyone that we'll be back on Tuesday, and we have Stanley Dash. And if you're looking for a broker, well, Stanley Dash is with TradeStation, and he'll be talking about spot versus FX options. And at TradeStation, you can actually trade both, so that's great. He'll be here on May 27th, and Jack's going to be back with us on May 28th. Jack, thanks again, and have a great evening.
Thanks. You too, Steve. Take care.
Thank you. On the behalf of the International Securities Exchange, this is Steve Meisinger, your host, saying thank you very much for attending today's webinar, and I hope that you come back very, very soon. Have a great evening, and have a happy trading day tomorrow. Take care. Bye now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.